For years, investors have been told that the silver market is transparent, efficient, and backed by real supply. But what if the numbers don't tell the whole story? What if the world's largest precious metals exchange is hiding cracks beneath the surface? Today, we'll examine the evidence, separate facts from speculation, and explore whether the Comex truly reflects the physical silver market, or if we're witnessing one of the biggest disconnects in modern financial history. If you own silver, plan to buy it, or simply want to understand what's really driving prices, this discussion could change how you view the market. When people hear the word Comex, they often imagine a massive warehouse filled with silver bars changing hands every day. The reality is much more complex. Comex is not simply a place where investors buy physical silver and carry it home. It is a futures exchange where contracts representing silver are traded, allowing miners, refiners, manufacturers, institutional investors, hedge funds, and speculators to manage price risk or take positions based on expectations of future price movements. Understanding this distinction is essential because many misunderstandings about the silver market begin with confusing paper contracts with physical ownership. A silver futures contract represents an agreement to buy or sell a specified quantity of silver at a predetermined price for delivery during a particular month. The majority of these contracts never result in physical delivery. Instead, traders close their positions before expiration by selling or buying offsetting contracts. This means that millions of ounces of silver can be traded on paper in a single trading session without a single ounce of metal actually moving from one vault to another. For newcomers, this often seems strange because the trading volume appears far larger than the amount of physical silver available. Yet this is a normal characteristic of futures markets across many commodities, including oil, wheat, copper, and gold. The original purpose of futures markets was not speculation. They were created to help producers and consumers reduce uncertainty. Imagine a mining company planning to produce silver over the next 6 months. The company faces the risk that silver prices could decline before its production reaches the market. By selling futures contracts today, the miner can lock in a price, providing greater certainty for budgeting, payroll, equipment purchases, and long-term planning. On the other side, an industrial manufacturer that requires silver for electronics or solar panels may buy futures contracts to protect itself against rising prices. Both parties use the exchange as a risk management tool rather than as a way to acquire or dispose of physical silver immediately. Over time, financial participants entered these markets because they recognized opportunities to profit from price movements. Hedge funds, commodity trading advisors, banks, proprietary trading firms, and retail investors all became active participants. These traders add liquidity, making it easier for commercial users to enter and exit positions efficiently. Without speculative participation, futures markets would often have wider spreads and less efficient price discovery. Although speculation is sometimes criticized, it plays an important role in ensuring that buyers and sellers can transact with relative ease. Price discovery is another concept that deserves attention. Many people assume the price of silver is determined primarily by local coin shops or bullion dealers. In reality, the global benchmark price is heavily influenced by futures trading. Thousands of participants continuously analyze economic reports, inflation expectations, interest rates, industrial demand, mining production, currency movements, geopolitical developments, and investor sentiment. Every buy and sell order contributes to a constantly changing market price that reflects the collective expectations of participants around the world. This process is remarkably efficient, but it is not perfect. Prices in futures markets reflect expectations as much as current physical conditions. If traders anticipate weaker economic growth, they may sell silver contracts before industrial demand actually slows. Conversely, expectations of monetary easing, higher inflation, or increased investment demand can push prices higher before physical shortages become apparent. This forward-looking nature explains why silver prices sometimes move in ways that seem disconnected from current headlines. One of the most misunderstood aspects of Comex involves warehouse inventories. The exchange publishes reports showing the amount of silver stored in approved vaults. These inventories are generally divided into two categories: eligible and registered. Eligible silver meets exchange specifications and is stored in approved facilities, but it has not been designated for delivery against futures contracts. Registered silver, by contrast, has been made available for delivery if contract holders choose to take physical settlement. Observers often focus on changes in these categories because they may provide clues about market conditions, but interpreting them requires caution. Movements between eligible and registered status can occur for administrative, logistical, or commercial reasons and do not necessarily indicate a shortage or surplus. Delivery itself is another area surrounded by misconceptions. When a futures contract reaches expiration, holders generally have several options. Many traders close their positions before the delivery period begins. Others roll their contracts into future months, maintaining market exposure without taking delivery. A relatively small percentage of participants actually complete the delivery process, receiving warehouse warrants that represent ownership of exchange-approved silver stored in authorized vaults. This system allows commercial users who genuinely require metal to obtain it while enabling financial participants to manage price exposure without handling physical bullion. The distinction between paper trading and physical ownership often fuels debate among precious metals investors. Some argue that because paper trading volumes exceed physical production many times over, futures prices may not fully reflect conditions in the retail bullion market. Others respond that futures markets are designed precisely to facilitate price discovery and risk transfer, not to match daily trading volume with physical inventory on a one-to-one basis. Both perspectives contribute to an ongoing discussion about how modern commodity markets function and where price signals originate. Silver itself occupies a unique position among commodities. Unlike many industrial metals, it also serves as an investment asset. During periods of economic uncertainty, investors may purchase silver as a store of value alongside gold. At the same time, silver is an essential industrial material used in electronics, solar panels, medical equipment, automotive systems, and numerous emerging technologies. Because of this dual role, silver prices often respond simultaneously to monetary factors and industrial fundamentals, creating volatility that can surprise even experienced market participants. Interest rates represent one of the most influential forces affecting silver prices. When real interest rates rise, income-producing assets become relatively more attractive, reducing demand for precious metals that generate no yield. Conversely, declining real interest rates often increase interest in silver and gold as alternative stores of value. Currency movements, particularly changes in the strength of the US dollar, also influence silver prices because the metal is primarily priced in dollars. A weaker dollar can make silver more affordable for international buyers, potentially increasing demand. Inflation expectations add another layer of complexity. Investors frequently purchase silver when they believe purchasing power may erode over time. Whether inflation ultimately materializes is less important than market expectations themselves. Futures prices often respond rapidly as participants reassess economic conditions, central bank policies, and fiscal developments. This responsiveness can create significant price swings even when physical supply remains relatively stable. Industrial demand has become increasingly important in recent years. The expansion of renewable energy technologies, particularly solar power, has increased silver consumption. Electric vehicles, advanced electronics, and medical applications also require substantial amounts of silver due to its exceptional electrical and thermal conductivity. These long-term demand trends attract considerable attention from investors attempting to estimate future supply and demand balances. Supply dynamics are equally important. Most silver production comes not from dedicated silver mines but as a byproduct of mining for copper, lead, zinc, and gold. As a result, silver output often depends on economic conditions affecting other metals rather than silver prices alone. Even if silver prices rise sharply, production cannot always increase quickly because mining decisions are driven by multiple commodities and require years of planning and investment. Market psychology frequently amplifies these fundamental forces. Financial markets are driven not only by data but also by expectations, fear, optimism, momentum, and positioning. A surprising economic report, central bank announcement, geopolitical event, or shift in investor sentiment can trigger rapid buying or selling. Algorithmic trading systems and high-frequency participants may accelerate these moves by responding instantly to market signals. While such volatility can appear dramatic, it reflects the highly interconnected nature of modern financial markets. Risk management is another central feature of futures exchanges. Participants must maintain margin requirements that ensure they can meet their financial obligations. If prices move significantly against a trader's position, additional funds may be required to keep the position open. This system helps maintain market integrity by reducing counterparty risk and ensuring that contractual obligations are supported by adequate financial resources. Clearinghouses stand between buyers and sellers, guaranteeing contract performance even if one participant experiences financial difficulty. Transparency also plays a significant role in understanding Comex operations. The exchange publishes detailed information regarding open interest, warehouse stocks, contract specifications, delivery notices, trading rules, and settlement procedures. Regulators monitor trading activity for potential manipulation, excessive concentration, or abusive practices. While debates continue regarding the interpretation of certain data and the effectiveness of oversight, much of the operational framework is publicly available for analysis. Open interest provides another valuable indicator for market observers. It represents the total number of outstanding futures contracts that remain open at a given time. Rising open interest alongside increasing prices may suggest new money entering the market, while declining open interest during price declines may indicate liquidation of existing positions. Analysts combine open interest with volume, positioning reports, and macroeconomic data to develop broader views of market sentiment. The Commitment of Traders report offers additional insight into market participation by categorizing positions held by commercial hedgers, managed money, and other reporting groups. Investors often examine these reports to understand how different categories of traders are positioned. However, interpreting these data requires experience because extreme positioning can persist longer than expected, and no single report provides a complete picture of future price direction. Understanding Comex ultimately requires recognizing that it is a marketplace built around financial contracts, risk management, and price discovery rather than daily exchanges of physical bullion. Physical silver remains a crucial foundation of the market, but futures contracts allow participants to transfer risk efficiently without requiring every transaction to involve immediate delivery. This structure creates enormous trading volume relative to physical inventories, a feature that often surprises newcomers but reflects the design of futures markets across the global economy. One of the most important concepts every silver investor must understand is the distinction between paper silver and physical silver. These two forms of exposure to the silver market are often discussed as though they are interchangeable, but they serve different purposes, involve different risks, and attract different types of participants. Confusing the two can lead to unrealistic expectations about how the market functions and why prices sometimes move in ways that appear disconnected from conditions in the physical bullion market. Physical silver is exactly what the name suggests. It is silver that exists in tangible form, such as coins, bars, rounds, industrial products, or large bullion bars stored in secure vaults. When an investor purchases physical silver, they own a real asset that can be held, transported, stored, insured, or transferred to another owner. Its value is derived from the metal itself rather than from the promise of another party. Ownership of physical silver generally removes direct counterparty risk because the investor possesses the asset or has a clearly defined ownership interest in allocated storage. Paper silver, by contrast, refers to financial instruments whose value is linked to silver without requiring the investor to own or take possession of physical metal. These instruments include futures contracts, exchange-traded funds, options, mining company shares, structured products, and other derivatives. Each of these vehicles provides exposure to silver prices in different ways, but they do not all represent direct ownership of bullion. Understanding this distinction is critical because each instrument carries its own advantages, limitations, and risks. Futures contracts remain one of the largest forms of paper silver trading. These standardized agreements allow participants to buy or sell silver at a predetermined price for delivery during a future month. Although delivery is possible under exchange rules, most contracts are closed before expiration or rolled into later months. As a result, the overwhelming majority of futures trading functions as financial exposure rather than a mechanism for acquiring physical silver. Exchange-traded funds provide another popular method of gaining silver exposure. Many investors choose these products because they can buy and sell shares through ordinary brokerage accounts without worrying about transportation, insurance, or storage. Depending on the structure of the fund, shares may be supported by physical bullion, but individual shareholders generally cannot redeem small holdings for bars or coins. Instead, they gain price exposure while relying on the fund's operational structure and custodial arrangements. Mining stocks represent another form of indirect exposure. Investors purchasing shares of a silver mining company are not buying silver itself. They are buying ownership in a business whose profitability depends partly on silver prices, operating efficiency, production costs, exploration success, management decisions, financing conditions, political stability in mining jurisdictions, and numerous other factors. As a result, mining shares can outperform or underperform silver prices over extended periods. Options add yet another layer of complexity. Rather than purchasing silver directly, options give investors the right but not the obligation to buy or sell futures contracts under predetermined conditions before expiration. These instruments are commonly used for speculation, hedging, or income generation, and can magnify both gains and losses because of their leverage and time-sensitive nature. The popularity of paper silver stems largely from convenience. Buying or selling a futures contract or ETF requires only a brokerage account, whereas purchasing physical silver involves selecting products, arranging delivery, securing storage, and often paying premiums above the spot price. For institutional investors managing billions of dollars, paper instruments provide speed, liquidity, and operational efficiency that physical ownership cannot easily match. Liquidity is one of the defining characteristics of paper markets. Futures contracts can be bought and sold within fractions of a second, allowing traders to respond immediately to economic data, central bank announcements, geopolitical developments, or changes in market sentiment. Physical silver transactions, by comparison, require manufacturing, shipping, authentication, inventory management, and settlement processes that naturally take more time. This difference in liquidity helps explain why silver prices often react instantly to financial news, even though no physical metal has changed hands. When inflation data surprises the market, employment reports exceed expectations, or interest rate guidance changes, thousands of financial participants adjust their positions almost simultaneously. Futures markets absorb these transactions rapidly, producing immediate price changes that later influence physical dealers around the world. Another important distinction involves leverage. Futures trading allows participants to control large amounts of silver while committing only a fraction of the total contract value as margin. This creates significant financial efficiency but also increases risk because relatively small price movements can generate substantial gains or losses. Physical silver purchases generally require payment for the full value of the metal, eliminating leverage unless external financing is used. Because leverage amplifies both profits and losses, leverage traders often react more aggressively to market movements. Margin calls can force participants to liquidate positions during periods of heightened volatility. These forced liquidations may accelerate price swings even if the underlying supply and demand for physical silver remain relatively unchanged. Understanding this dynamic helps explain why futures markets sometimes experience sharp movements over short periods. Storage represents another major difference. Physical silver owners must decide how and where to store their metal. Some choose home safes, while others prefer bank safe, deposit boxes, or professional vaulting services. Storage involves security considerations, insurance costs, and accessibility. Paper silver eliminates many of these logistical concerns because ownership exists electronically rather than physically. However, removing storage responsibilities also changes the nature of ownership. A physical silver holder knows exactly what asset they possess. Paper investors instead rely on the contractual structure governing their investment. Depending on the product, investors may depend on clearinghouses, custodians, trustees, fund managers, or other financial institutions to fulfill obligations according to established rules and regulations. Premiums provide another area where physical and paper markets differ. The spot price, commonly quoted in financial news, reflects benchmark trading activity, largely influenced by futures markets. Physical products such as coins and bars typically sell above the spot price because fabrication, refining, transportation, dealer operations, inventory management, and market conditions all contribute additional costs. During periods of strong retail demand, these premiums may widen substantially even when benchmark prices remain relatively stable. Conversely, during periods of weaker retail demand, premiums may narrow as dealers compete for customers and inventory accumulates. These fluctuations demonstrate that the retail physical market operates according to its own supply and demand dynamics while still using futures prices as the primary pricing benchmark. Industrial users approach silver differently than individual investors. Manufacturers purchasing silver for electronics, medical equipment, photovoltaic cells, or specialized industrial applications focus primarily on obtaining reliable supplies at competitive prices. Many of these companies use futures contracts to hedge purchasing costs while simultaneously arranging physical deliveries through commercial supply chains. In this way, paper and physical markets work together rather than existing as completely separate systems. Refiners and bullion dealers also interact with both markets. They frequently use futures contracts to hedge inventory exposure while buying and selling physical metal with customers. Hedging allows these businesses to manage price risk between the time they acquire inventory and the time they sell finished products. Without futures markets, operating such businesses would involve considerably greater financial uncertainty. One reason debates about paper silver persist is the relationship between trading volume and physical production. Daily futures trading volume often exceeds annual global mine production when measured on a notional basis. To some observers, this appears inconsistent with the availability of physical silver. However, financial contracts frequently change hands many times before expiration, meaning the same notional ounces may be represented repeatedly through active trading. This characteristic is common across many futures markets and reflects the transfer of financial risk rather than repeated movement of physical commodities. Market participants also differ significantly in their objectives. A mining company seeks price stability for future production. A hedge fund may seek short-term profits from macroeconomic trends. A manufacturer wants predictable input costs. A retail investor may desire long-term wealth preservation. A momentum trader may hold positions for only minutes. Because these participants pursue different goals, their buying and selling decisions often occur independently of immediate physical consumption. Volatility often highlights these differences. During periods of financial stress, investors may rapidly liquidate futures positions to raise cash or reduce portfolio risk. Such selling can temporarily pressure benchmark silver prices, even while physical demand remains resilient. Conversely, strong speculative buying can push futures prices higher before physical demand fully reflects those expectations. These differences illustrate how financial markets frequently anticipate future developments rather than simply responding to present conditions. Transparency varies across investment vehicles. Exchange-traded products typically publish regular disclosures regarding holdings, while futures exchanges provide extensive information about trading activity, warehouse stocks, open interest, and contract specifications. Physical ownership, on the other hand, depends primarily on individual custody arrangements and private transactions. Each form of ownership offers different degrees of visibility depending on the circumstances. Counterparty considerations also deserve attention. Holding physical silver directly minimizes reliance on financial intermediaries because the investor controls the asset. Paper investments involve contractual relationships with exchanges, brokers, custodians, clearing organizations, or fund managers. These systems are designed with safeguards intended to reduce operational risk, yet they remain fundamentally different from direct possession of bullion. Tax treatment may also differ depending on jurisdiction and investment structure. Physical bullion exchange-traded funds, mining shares, and derivatives can each fall under different tax rules, influencing investor decisions. Professional advice is often necessary because regulations vary considerably between countries. Long-term investors frequently choose physical silver